As I mentioned in my previous video, there is 95.45% probability that the price volatility occurs in the Bollinger Band. Given above, we should adopt this type of trading strategy, which goes as follows. Sell when the price breaks above the upper band, or buy when the price falls below the lower band. So why does around 95% of price volatility occur in the Bollinger Band? I will explain more about the Bollinger Band in this video. Please subscribe to my channel if you would like to know more. Now, to understand how does the Bollinger Band work, we should figure out the meaning of Gaussian distribution firstly. Gaussian distribution is also known as normal distribution. Put in simple terms, if sample sizes are large enough, a sampling distribution will normally distributed with few key members at the high and low ends and many in the middle. For example, if the height of human beings follow the Gaussian distribution according to the 68-95-99.7 rule, the values within one standard deviation of the mean account for about 68.27% of the set, while within two standard deviations account for 95.45%, and within the three standard deviations account for about 99.73%, which covers the overwhelming majority of human heights, even the extremely tall or short ones. We are able to apply this rule to the stock investment. The first step is to calculate the average daily price of a particular stock and then connect them to create a singular flowing line. If the stock prices are assumed to be normally distributed, 95.45% of candlestick charts will be within plus or minus two standard deviations of the mean of the stock prices. There is only 2.3 probability that candlestick charts fall outside the upper band or lower band. Did you catch that? This is exactly how the Bollinger Band is formed. From it, we can see that the 95% of price volatility occurs within the Bollinger Band. This result is based on the Gaussian distribution assumption and the 68-95-99.7 rule. Why do the upper or lower bands act as support and resistance levels? Allow me to explain it in detail. There is only 2.3% probability that prices reaches or moves above the upper band. When the price moves above near the upper band will act as a resistance and the possibility of a short-term correction will be high. At this time, we should choose to sell. There is also only 2.3% probability that price reaches or falls below the lower band. When the price moves near the lower band will naturally act as support and the possibility of a short-term rebound will be high. At this time, we should choose to buy. That's why the Bollinger Band acts as support or resistance. Why does the Bollinger Band widen or narrow? Bollinger Bands use two key parameters, which is length and the standard deviations. As seen in this picture, the length mainly affects the middle band. The middle band represents the moving average, which is one of the most popular technical indicators. For most systems, the default length of Bollinger Band is 20, namely the 20-day moving average. The multiples of standard deviations mainly affect the upper and lower band. The upper band is the 20-day moving average plus standard deviations, whereas the lower band is the 20-day moving average minus standard deviations. For most systems, the default standard deviation is 2. Hence, the upper band is the 20-day moving average plus 2 standard deviations, while the lower band is the 20-day moving average minus 2 standard deviations. So how do we go about to calculate the standard deviation? It is kind of complicated, so I am not going to explain it here. One conclusion that we can derive here is that we should remember that the standard deviation is larger when the data values show more variation from the mean, and is small when the data are all concentrated close to the mean. As mentioned earlier, we use a 20-day moving average for the middle band, which averages the closing price for the last 20 days. These data are also used for calculating the standard deviation, which is used to determine the values of the upper and lower bands. For the last 20 days, higher market volatility means a larger standard deviation. Then, the distance between the upper and lower band will widen. On the contrary, lower market volatility means a smaller standard deviation. Then, the distance between the upper and lower band will narrow. This is why the Bollinger Band widen or narrow. The standard deviation indicates the volatility of stock prices in recent days, which is reflected in the band change. Now, why do we say when the band widens, the market is about to initiate a new move? The reason is simple. The higher volatility of stock price for the last 20 days, the greater standard deviation. The greater standard deviation, the longer distance between the upper and lower band. Hence, the longer distance between the upper band and lower bands, naturally, the wider the Bollinger Band will be. More volatile stock prices means more fierce competition among the buyers and sellers alike, which is likely to initiate a new market movement. When the band widens, how do we judge the market will move either upward or downward? Just look at the middle band. The moving average seems like an average cost line. Take the 20-day moving average as an example. It means the average buying cost for the last 20 days. If the stock price is above the average cost line, it means that most investors gain profit for the last 20 days might not consider placing a stop loss order, indicating a powerful short-term market trend. If the stock price is below the average cost line, it means that most investors suffer loss for the last 20 days. Then, stop loss orders would be triggered, indicating a weakened short-term market trend. Therefore, when the band widens, if the price moves above the middle band, it means the market trend is strong and would continue to rise. If the price falls below the middle band, it suggests that the market trend is weak and would continue to fall. Finally, I would and must stress this, that mastering the Bollinger Band is no guarantee of future investment performance. This video merely aims to help beginners understand indicators and learn investing skills. If you are interested in investing and eager for earnings, please subscribe to my channel. I will update regularly with more investment tips. See you next time.